Let me give you three numbers: 20%, $111, $84.37. 20% is the share of global oil supply that flows through the Strait of Hormuz every single day. $111 is what Brent crude hit when that supply was cut off. $84.37 is what silver is trading at right now. And those three numbers tell a story that almost nobody is connecting properly. Because here is what just happened. Oil just posted a move that broke every record in modern energy market history. Brent crude surged past $111 per barrel. WTI hit $130.30, a 24.6% move in one session. The biggest single session oil gain since the history of oil futures trading began in 1983. Not the biggest this year, not the biggest this decade, the biggest ever recorded. In 43 years of data, the reason is 21 miles of water that the world economy depends on like a patient depends on oxygen. The Strait of Hormuz, effectively closed, not slowing, not reducing, closed. Over 200 ships are currently anchored outside that strait, loaded with crude oil, nowhere to go. The UAE, Kuwait, and Iraq have already announced production cuts, not because they want to, but because there is literally nowhere to store the oil they are pumping. Gulf storage is at capacity, the strait is shut, the oil has nowhere to move. And the CSIS chair in energy and geopolitics, Clayton Siegel, said it plainly on live television. Quote, "The grace period that the market had in place for most of last week, assuming that this thing would not get out of control, has clearly come to an end. We're probably going to have a crisis period for longer. The grace period is over, and right now silver is sitting at $84.37. That number is wrong. Not wrong as in a data error, wrong as in it is describing a world that no longer exists, a world where 20% of global oil supply flows freely through a 21-mile waterway. A world where the largest energy shock since the 1973 Arab oil embargo has not yet been priced into the metal that sits at the exact intersection of every force this crisis unleashes. I am going to show you exactly what that means. Why silver specifically, not just gold, not just oil stocks, not just any other asset, sits at the precise intersection of every force this crisis is now unleashing. Why Rapidan Energy Group just called this disruption more than double the previous record set during the Suez Crisis of 1956. And why the Barclays analysts who told clients Brent could hit $120 are using the same language the most credible analysts used in 1973, right before precious metals made their most extraordinary move in modern history. Stay with me, because this is the complete picture. And by the end of it, you are going to understand why $84.37 and $111 oil cannot exist at the same price level for very much longer. Let me start with what actually happened. Because the mainstream coverage has been focused on the oil number. And the oil number is real, but it is not the whole story. On February 28, 2026, the United States and Israel launched Operation Epic Fury, coordinated precision strikes on Iranian nuclear facilities, military infrastructure, and leadership command centers. Supreme Leader Ali Khamenei was killed. Iran's top IRGC commanders were eliminated. Over 2,000 targets struck in the opening 72-hour window. Iran's response was not a direct military counterattack it could not win. It was something far more strategically effective. Cheap drones, small, inexpensive, deployed not to sink the U.S. Navy but to make the Strait of Hormuz uninsurable. Several tankers were struck near the strait within days. The message was clear. Any commercial vessel attempting transit does so without protection. The insurance market responded. Guard, Skuld, North Standard, Lloyd's, the London P&I Club, the American Club. Every major marine insurance provider canceled war risk coverage for the region. What that created was not a military blockade. It was something more powerful, a financial blockade. Ships do not move without insurance. No captain risks a $100 million vessel and a crew of 20 people on an uninsured route through an active war zone. The ships do not move. The oil does not move. And here is the number that Rapidan Energy Group published that should stop everyone who reads it cold. The Iran war has disrupted 20% of global oil supply for 9 days and counting. That is more than double the previous record set during the Suez Crisis of 1956 to 1957, which disrupted just under 10%. Double the previous record in 9 days, with no confirmed timeline for resolution. Trump has said he will not stop military operations until Iran offers unconditional surrender. Iran's remaining leadership has said the Islamic Republic will never surrender. There's no diplomatic channel currently open that has the confidence of either side. The U.S. government offered to provide naval escorts and insurance backstops. A good idea on paper. But J.P. Morgan Chase estimated the amount of insurance required to cover all the tankers in the Gulf at more than $350 billion. The U.S. government's coverage offer, $20 billion rolling, covers less than 6% of what is needed. U.S. Energy Secretary Chris Wright went on CNN and said traffic through the strait would resume once Washington destroys Tehran's ability to threaten shipping. That statement is not a timeline. It is a military objective with no completion date attached. The result is that over 20 million barrels of oil per day are currently unable to move through the strait, every single day, with nowhere to go. And storage across the Gulf region is full. The oil is being pumped and immediately stored locally because there is no exit. Gulf producers, Kuwait, UAE, Iraq, are cutting production not because of strategy, but because they have run out of room to put what they are producing. UBS put their Brent outlook directly. If the current situation persists for another couple of weeks, Brent prices could test $120. Their exact words. These numbers might seem too high, especially given widespread pessimism about the oil market outlook heading into this year, but we reiterate that fundamentals are stronger and risks are bigger than the Russia-Ukraine conflict. When we saw these levels materialize, bigger than Russia-Ukraine, from the same analysts who called that one correctly. Now let me show you why this is not just an oil story. Why this is specifically a silver story in a way that almost no mainstream analysis is capturing. Silver sits at the exact intersection of four forces that this oil shock simultaneously activates. And understanding why requires understanding something fundamental about what silver actually is. Silver is not just a safe haven metal. It is an industrial commodity that is manufactured at every single stage of its production using oil. Here's the exact chain. Underground extraction. Massive diesel-powered excavators running continuously to pull silver-bearing ore from the ground. The diesel that runs those machines is priced in oil. When Brent moves from $70 to $111, the fuel cost for every operating silver mine on Earth increases by roughly 58%. Not next quarter, right now, on every current delivery contract. Crushing and milling. Millions of tons of ore ground down to extract the silver content. Electrically powered, energy intensive. And in the major silver-producing nations, Mexico, Peru, Bolivia, Argentina, the electricity grid runs heavily on oil and natural gas, both of which just repriced violently. Chemical refining, sustained heat, industrial electricity, chemical inputs that are themselves petroleum derivatives. Every step costs more when oil hits $111. Transportation. Refined silver moving from processing facilities in Latin America and Asia to industrial buyers in Europe, North America, and East Asia. That movement runs on diesel trucks, diesel-powered ships, and freight networks that are currently experiencing surcharges of $2,000 to $4,000 per container from CMA CGM alone. Every link in that chain is an energy cost. Every energy cost just repriced. And the repricing is not temporary in the way most people assume. Mining companies do not reset their financial models based on where oil was last month. They reset them based on where oil is expected to be going forward. And right now, with the Strait of Hormuz effectively closed and no timeline for reopening, every energy market model on Earth is pricing oil elevated for weeks at minimum. The energy cost to produce 1 ounce of silver at $70 oil, approximately $8 to $12 per ounce. The energy cost to produce 1 ounce of silver at $111 oil, closer to $18 to $22 per ounce. At $121 oil, which Goldman Sachs models as the base case if Hormuz flows remain disrupted, approaching $25 per ounce. That is a production cost floor that has permanently moved. The paper price of silver has not moved to reflect it, not even close. And here is the second force, the inflation transmission mechanism that the Federal Reserve cannot escape. Every $10 move higher in oil adds approximately 20 basis points of inflation pressure to the U.S. economy. Oil has moved from roughly $60 to $111 in the past 10 days. That is already more than a full percentage point of additional CPI pressure building in the pipeline before the next reading even prints. Gas pump prices have already jumped 50 cents in a week, according to AUA. GasBuddy's head of petroleum analysis, Patrick DeHaan, says there is an 80% probability of hitting a $4 national average within weeks. And on top of that, the jobs report that just dropped showed the U.S. economy shed 92,000 jobs in February. Wall Street consensus was a gain of 60,000. Not a miss, a reversal. Jobs falling, wages holding at 3.8% annualized. Oil at $111 and rising. There is one name for what those three conditions produce simultaneously: stagflation. The Federal Reserve is sealed inside a room where every door leads to damage. Cut rates to address job losses. You pour fuel on an inflation fire that $111 oil is already feeding. Hold rates to contain inflation. You accelerate job losses that are already printing negative. In every stagflation period in modern financial history, hard assets have been the only place capital flows that has consistently preserved purchasing power. Not stocks, not bonds, not cash. Hard assets. Gold went from $35 in 1971 to $850 by 1980 during the stagflation decade. Silver went from under $2 to $50. That is a 33 times return driven entirely by the market's recognition that fiat currency cannot absorb an energy shock without debasement. And here's the structural difference between then and now that makes the current setup more powerful, not less. In 1973, the U.S. national debt was manageable. Paul Volcker had room to raise the federal funds rate to 20% to break the inflation. That option closed the door on precious metals temporarily, but the damage to metals holders before that happened was extraordinary. The U.S. national debt right now is above $36 trillion. Annual interest payments at current rates exceed $1.2 trillion. The Fed cannot raise rates to 20% without triggering a sovereign debt crisis. The policy tool that ended the 1970s bull run in precious metals does not exist in 2026. The exit that closed the door on silver at $50 in 1980 is not available this time. Rapidan Energy Group said it directly. This disruption is more than double the previous record set during the Suez Crisis. The 1973 template is not a ceiling for what happens next. It is a floor. Now, let me show you the third force, the one that makes silver specifically more explosive than gold in this environment. Silver is the only safe haven asset on Earth that is simultaneously a monetary hedge and an industrial critical mineral. Industrial demand for silver does not disappear when geopolitical risk spikes. It accelerates. Because the transition away from fossil fuel energy, which becomes more urgent the moment oil hits $111, requires silver at every step. Every solar panel requires silver. A standard photovoltaic panel uses roughly 20 grams of silver in its conductive paste. The global solar installation target for 2026 was set before any of this happened. Those panels still need to be built. The solar manufacturers still need the silver. Every EV battery management system requires silver. Every 5G antenna, every AI server thermal management system, every medical imaging device, the industrial users of silver do not pause procurement when oil spikes. They accelerate it. Because the energy crisis makes the case for alternative energy infrastructure more urgent, not less. And here is the cruel irony that the paper price at $84 has not processed. The same energy shock that is driving oil to $111 is simultaneously making the transition to solar and EVs more economically compelling. More investment in solar, more demand for silver. At the same moment, the energy cost of producing silver has permanently moved higher. Silver demand goes up on both the safe haven side and the industrial side simultaneously. Silver supply cost goes up. The paper price sits at $84. The fourth force is the physical vault reality, and this is the one that the paper market cannot ignore indefinitely. COMEX registered silver, the metal actually available for futures delivery, has fallen 75% from the 346 million ounces held in 2020. Right now it sits around 82 to 87 million ounces, draining at approximately 785,000 ounces per trading day. The March 2026 futures contract represents exposure to 528 million ounces against that 82 to 87 million ounces of registered inventory. Think about what that ratio means. For every physical ounce available for delivery, there are roughly 6 ounces of paper claim outstanding, and that ratio is before a war-driven safe haven demand spike forces additional delivery requests. In January 2026, over 33 million ounces were withdrawn from COMEX in a single week, 26% of registered inventory in 7 days. The Shanghai Futures Exchange is draining at 62.5 metric tons per day. The Shanghai Gold Exchange pulled 436 tons in the first 2 months of the year, more than double the historical average. 3 exchanges, 3 continents, all draining simultaneously before the oil shock, before $111 Brent, before the financial blockade of the Strait of Hormuz. Right now, if you try to acquire physical silver from a major bullion dealer, the actual transaction price includes a premium of $6 to $8 over spot. The real cost of physical silver entering your possession is between $90 and $92 per ounce, not $84. The paper market says $84. The physical market says $90 to $92. And that gap opened before most institutional investors have even begun reassessing their paper exposure in light of a war that just posted the biggest oil move in 43 years of recorded futures history. Now here is why the mainstream safe haven argument is incomplete. And this is the part that separates understanding silver specifically from just understanding precious metals generally. When the war escalated sharply on certain sessions, gold and silver initially fell. The dollar surged. Investors fled to U.S. dollar positions in the first 24 to 48 hours of acute shock. That is the historical pattern. Peter Grant at Zaner Metals described it precisely. In the short term, the dollar outperforms gold as a safe haven, but that calculus shifts quickly. Here is why the dollar safe haven bid is temporary and the silver bid is structural. The dollar's safe haven status depends on confidence in U.S. fiscal and monetary management. The same war that is driving people to dollars is simultaneously adding CPI pressure that the Fed cannot address without triggering a debt crisis. The dollar safe haven bid is self-liquidating. The more oil spikes, the more inflation pressures the Fed. The more the dollar's real purchasing power erodes, the weaker its safe haven claim becomes over the medium term. Silver's safe haven bid has no such contradiction. Silver is not somebody's liability. It is not a claim on a government's fiscal credibility. It is not dependent on the Fed making the right call. An ounce of silver in your hand does not require the SWIFT network to function. It cannot be frozen by a sanctions decree. It does not have a counterparty whose solvency you need to evaluate. The dollar safe haven bid peaks in the first 72 hours of acute shock and fades as the medium-term inflation implications become undeniable. The silver bid begins during those 72 hours and accelerates as the inflation reality accumulates month after month. And the institutional analysts are already saying what comes next. FX Empire analysts say silver will likely break $120 in 2026 and move toward $150. They cite the war escalation, the safe haven demand surge, and the industrial demand acceleration as converging forces. JP Morgan has raised their gold target to $6,300 per ounce for 2026. At the current gold-silver ratio, $6,300 gold implies silver above $100 at historical ratio norms. Goldman Sachs maintains their bullish stance on gold at $5,400 average by year-end. Bank of America's metals research chief had already put $135 to $309 on silver before this crisis deepened. Every major institutional metals analyst is using the same framework. The stagflation environment, the energy shock, the supply deficit, the vault drain, the de-dollarization acceleration, all pointing the same direction. Now, let me give you the honest picture, because I am not here to give you a one-sided story. Silver fell hard during certain sessions of this war's escalation. When the dollar surged on acute shock days, silver dropped 7 to 8% intraday before recovering. The beta of silver, how much it moves relative to the benchmark, runs at 2.54. That amplification works in both directions. Violent downside sessions are part of this market's structure. A ceasefire that reopens the strait faster than anyone expects would remove the acute war premium from oil. Silver's geopolitical bid would soften temporarily. Price could retrace to the $78 to $75 support zone. A G7 coordinated strategic reserve release, which is being actively discussed, could cool oil's immediate spike. If Brent falls from $111 back toward $90 to $95, some of the energy cost inflation narrative temporarily loses urgency. These are real risks. Size positions to survive the violent sessions. Because in this market, the violent sessions are not anomalies. They are the price of participation. But here is what those bear scenarios cannot change. A G7 reserve release does not reopen the Strait of Hormuz. It temporarily supplements supply. The moment the release ends, the supply gap reasserts. A ceasefire announcement does not immediately restore insurance coverage. The marine insurance market does not flip back overnight. Guard and Lloyd's do not cancel their war risk exclusions because a ceasefire was announced. They wait for stability to be confirmed over weeks. The financial blockade loosens slowly even after the military situation changes. And none of it, no ceasefire, no reserve release, no diplomatic announcement, puts silver back into the COMEX vault that has lost 75% of its registered inventory since 2020. None of it reverses 436 tons of SGE withdrawals in 2 months. None of it eliminates the 6th consecutive annual silver deficit projected at approaching 200 million ounces in 2026. The Hormuz closure did not create the structural supply deficit in silver. It loaded the spring that was already compressed. The production cost floor has moved. The supply deficit is running. The vault drain continues. The physical premium is real at $6 to $8 over spot. The stagflation trap has the Fed sealed inside with no clean exit. And every major institutional metals analyst is pointing their price targets to numbers that look like fiction from where silver sits right now. Here's what to watch. 4 specific signals that tell you which scenario is materializing before any headline catches up. First signal. Brent crude direction over the coming days. Goldman Sachs models $100 as the base case if Hormuz flows remain disrupted for 5 weeks. UBS says $120 is possible before then. Every dollar Brent holds above $90 adds incremental inflation pressure that makes the Fed's position more impossible and silver's inflation hedge case more compelling. Watch Brent. It is the primary input into the energy cost reset for silver production. Second signal. Physical dealer premiums. Right now, they are at $6 to $8 over spot. In the 2020 physical shortage, premiums hit $8 over spot before exploding to $15 to $20 as inventory ran dry. In 2023, premiums hit $10 before allocation limits were imposed. Watch the premium at major dealers. When it crosses $10 to $12, that is the physical market broadcasting that the paper price is detaching from delivery reality. Third signal, the G7 strategic reserve decision. G7 finance ministers are discussing a coordinated release. If they announce a release and oil pulls back from $111 toward $90, watch silver's reaction. If silver holds above $82 through an oil pullback, that is the physical market telling you the structural bid is independent of the acute war premium. That would be the most bullish signal possible. Fourth signal, dollar index direction. The DXY has been elevated on the initial safe haven dollar bid. Every full point, the DXY drops from current elevated levels, puts $2 to $3 of direct upward pressure on silver mechanically. When the dollar safe haven bid exhausts itself, and historically it peaks within 72 hours of acute shock and fades from there, the mechanical headwind on silver reverses. 4 signals. Brent above $90. Physical dealer premiums crossing $10. Silver holding through an oil pullback. Dollar safe haven bid exhausting. Watch them in sequence. Most people watching this are watching the oil price and asking what it means for their gas bill. You are now watching the 4 signals that will tell you what the oil price means for the only asset that sits at the intersection of every force this crisis unleashes. That is a different game. Here's the line that I want you to carry from this video. 43 years of recorded oil futures history, biggest weekly gain ever. 9 days of Hormuz disruption, more than double the previous record. The Fed sealed in a stagflation trap. 3 exchange vaults draining simultaneously. Physical silver dealers already charging $90 to $92 for what the paper market says is worth $84. You can release strategic reserves. You can announce naval escorts. You can call a G7 emergency meeting. But you cannot reopen the Strait of Hormuz with a press conference. You cannot put 200 ships back in motion with a Truth Social post. You cannot reset the energy cost floor of silver production by releasing oil from reserves that took decades to accumulate. And you cannot put the silver back in the COMEX vault that has been draining for 3 consecutive years. The oil market found its price. Brent at $111 found its price because supply and demand in the real world forced it there. Silver at $84 has not found its price yet. Not in a world where $111 oil has permanently repriced the cost of every ounce coming out of the ground. Not in a world where 3 exchange vaults are simultaneously draining. Not in a world where physical dealers are charging $6 to $8 above the paper price before the institutional reassessment of paper exposure has even begun. The oil market already had its repricing moment. 43 years of records broken in one session. Silver is still waiting for its moment. The question is not whether. The question is when. And whether you are positioned before the moment arrives or after it. If you want to stay inside what is actually happening in the vaults, in the insurance markets, in the physical dealer networks, in the signals that move before the price moves, subscribe. Because the next leg of this story does not come with a warning. And by the time the mainstream figures out what silver and $111 oil mean together, the window that is open right now will be closed. Watch the vault, watch the premium, watch Brent.